Welcome to our third quarter video update for the year 2024. I'm joined by my colleagues Janet Kimsing, and I would like to also welcome back Paul Carter, Senior Portfolio Manager at Capstone Asset Management.
Paul, welcome back. You quickly become a regular here, and we're pleased to hear your thoughts once again. So without further ado, I'll jump right into our first question. There have been some recent challenges in the real estate market, specifically related to office space in our non-traditional equity fund. Can you talk about that?
Yeah, definitely. Thanks, Janet. Thanks, Maria. So COVID obviously brought about a lot of changes to the world and to the investment landscape. And one of the most impactful ones was the change in how we all work and the transition to the work from home culture. In both Canada and the US, the percentage of the working population who are working from home full time is roughly now triple what it was about a decade ago. And in the US, this translates to about 22 million workers, give or take. This has had a huge impact on the need for corporate office space. In cities across North America, but especially in the US, as leases are coming up for renewal, large corporations are downsizing their footprint or consolidating office locations. For owners of office properties, the situation has been really tough the last few years as there are fewer and fewer buyers of office buildings of any type. On top of that, commercial real estate lenders like banks have been deliberately trying to reduce their exposure to office properties. So, as mortgages come up for renewal, the property owners are finding it more difficult to refinance. Through the Capstone Non-Traditional Equity Pool, or what we call NTEP, a number of years ago, before COVID, we made investments in a few limited partnerships that invested largely in US office properties. Now, our exposure to office buildings has been coming down over the last few years as these LPs either sold some of these properties at a profit or moved into different asset types, like multifamily residential. However, there are still some residual properties in them that had to be written down in value in the context of this difficult environment. So while the office sector has not been a great part of the market to be invested in over the last little while, indications are that the worst is behind us. And certainly the movement towards work from home is starting to reverse somewhat. For instance, Amazon made waves recently by announcing a back to the office mandate for next year, and Salesforce and others are starting to do the same. So hopefully this will translate to better returns for NTEP going forward.
Thanks, Paul. Both the US and Canadian stock markets have performed quite strongly year to date. Is there still value in non-traditional assets given the strength in traditional markets?
Yeah, absolutely. I actually believe there's almost always value to be found in just about any asset class. As you mentioned, most stock markets have performed exceptionally well in 2024. Both the broad Canadian and US stock markets are up over 20% year to date, and international markets aren't too far behind. One byproduct of this strength, though, is that there are now pockets of the traditional equity markets that are definitely not good value anymore, at least in my opinion. A perfect example might be mega cap US technology stocks like NVIDIA that we've all heard about. NVIDIA, while it is an exceptional company that is taking advantage of the growth in the artificial intelligence space, now has a market cap of $4.5 trillion Canadian. So just to put that in perspective, how big that is more than the GDP of every nation on this planet, save for the US, China, Germany, Japan, and India. Now, to be clear, I am not saying that NVIDIA stock isn't going to keep going up in the near term, because it absolutely might. But I don't think that any company of 30,000 employees that has a market cap of $4.5 trillion represents good value for investors today. On the other hand, the valuations of private markets like private equity tend to follow the public markets. So we're excited about the value that we see currently within our non-traditional pools. For example, one of our private equity fund investments has significant exposure to spacecraft manufacturer SpaceX, which just raised a round of financing at a price 15% greater than the last round. The valuation of these new rounds of financing in the private equity space are driven in part by the valuation of the broad stock market, but it takes a little while for these new values to bleed into the net asset values of our funds. So because of this lag effect, I think there's a good chance for continued strength in some of our private equity investments.
Thanks, Paul. And how might the US elections impact the overall macroeconomic landscape in the US and subsequently the stock markets?
Yeah, a great and timely question. So firstly, I would caution investors not to make any material changes to their long-term asset mixes in response to their view about who's going to win. Making investment decisions based on the potential outcome of elections is not a reliable way to make money or protect capital. And on the contrary, it can often lead to costly mistakes. Historically, stocks have rewarded investors over the long term through either Democratic or Republican presidencies. For instance, over the last 9 elections, during the period from Election Day in November until the following June 30th, US stocks have posted strong positive returns 7 out of 9 times. Of the 2 times the market was down, one was after a Democrat win, Barack Obama, in 2008, and one was after a Republican win, George Bush Jr. in 2000. Although it looks like the odds of another Trump presidency is increasing in the final weeks leading up to the election, I cannot say with any confidence that that is what's going to happen. One of Trump's big proposals is to cut the corporate income tax rate from 21% to 15%. And if this comes to pass, this would be good for corporate profits and stock prices. This is likely one of the reasons that the S&P 500 has been up about 10% over the past couple of months or so. Conversely, certain Trump policies, such as raising tariffs sharply and then deporting immigrants, would likely be at least somewhat inflationary, which could result in interest rate increases, which in turn would be bad for stocks. Now, if Kamala Harris wins, certain tax proposals like raising the corporate income tax rate would be bad for the economy and bad for corporate profits and therefore stock prices. But on the flip side, markets may approve of a more stable and predictable president coming into power, which would be good for stocks. So regardless of how the election race unfolds, we are not terribly nervous and have been keeping our equity strategies as close to fully invested as practicable. The value tilts that we have within these strategies should serve to protect capital somewhat, should there be a short-term downturn in the markets that result from some election-related development.
Thank you, Paul. So it's not every day that we at Capstone have 2 mortgage or debt funds posting negative returns in a month. In fact, that's never been the case for us before. Can you talk through what happened in both the mortgage pool and the private high income pool this past quarter?
Yeah, thanks for that question, because it's an important one. While it's not uncommon for any of our pools to have a negative month, September did stand out, as you say, because both the Capstone mortgage pool and the Capstone private high income pool experienced declines. For the mortgage pool, the main issue stemmed from a second mortgage to an Ontario developer who pre-sold townhouse units at 2019 prices. Delays and rising costs, worsened by COVID, forced this project into receivership. Now, we had been working with a new developer to take over the project at a price that would have allowed our loan to be paid back, but that deal fell through unexpectedly, resulting in a negative impact to our performance. And we never like taking a performance hit like this, obviously. However, during difficult environments, these things will happen on occasion. Fortunately, we underwrite deals at high enough interest rates to compensate our investors for these risks over time. Now, even with this negative month, the Capstone mortgage pool has returned roughly 8% gross of fees over both the last 5 years and the last 10 years, and we remain very confident in its long-term potential. Now, in the Capstone private high-income pool, the negative return was tied to our investment in a Canadian vehicle associated with US-based Parkview Financial. Parkview lends to real estate developers across the US who have faced similar challenges to those in Canada. Increased operating costs and underperforming loans led to a write-down in September. However, we believe the worst is behind Parkview and are quite optimistic about the future of our investment.
Thanks, Paul. That's quite reassuring to hear. So what can we be excited about as we head into the last quarter of 2024?
Yeah, so as it relates to Capstone, I'm actually really excited about developments in a number of our funds and strategies. Despite recent turbulence in our mortgage pools that I just talked about, I think the shift towards lower interest rates that we've seen in both Canada and the US will improve the operating environment for real estate developers somewhat, which in turn should be good for our strategy. And we're seeing a lot of positive developments in our equity solutions. Our Capstone Canadian Equity Income strategy, for instance, has had a tremendous last couple of years performance-wise, and the underlying fundamentals of many companies that we're invested in are looking really good. And now that interest rates are coming down, many investors are starting to rotate out of high-flying technology stocks and into other sectors, including those that are more interest rate sensitive, such as banks, utilities, and real estate. As it turns out, the Canadian equity market is more heavily tilted towards these sectors than either the US market or most international markets. And so this could be a boon for the high dividend paying areas of the market that we tend to be focused on.
Well, thanks so much for joining us today, and we look forward to having you with us again soon. And to our viewers, we hope you enjoyed this quarterly update, and please stay tuned next month for the next edition of Your Wealth Matters. Goodbye for now.
Thank you, Paul, and bye for now.
Bye now.